Hey everybody, Preston Brent here with our Trader User Group, a weekly roundup. This is for the trading week ending July 19th, 2019. I lead it with consumers, or actually consumers are leading the way in the US. And I say the US markets, but the US consumer is definitely leading the way. Before we jump into the charts today for this weekly roundup, just a quick look at the global markets. Pretty much everything was in the red this week. There's just a couple of holdouts. Obviously, the VIX was up about 16% for the week. It finished the week at 1445. Last week it closed at 1239. Couldn't quite get down below into 11 handle. So it closed the week at 1445. The other lone holdout finishing slightly higher at just 4 basis points for the week in the world markets was the FTSE over in London. But outside of that, the Dow was down about 65 basis points, S&P down 1.23%. Russell was down 1.41%. NASDAQ down about 1.18%. Most of the markets globally were down too. The Nikkei was down over 1%. China was down about 22 basis points. DAX, the German DAX, down about 51 basis points. And the CAC 40, the French markets, it was down about 37 basis points. So, basically not a very big pullback, but just kind of a settling in of price. Now we're seeing the current forward PE ratio coming in at about 18.04. It's still slightly lower than when it was last January 2018, when it was up about 18.5 or so, and we had that big crash. The trailing PE ratio is at 23.02. That's the prior 12 months earnings. But the go forward numbers at 1804. So it's kind of reduces the trailing PE by about 21.63%, but it's still elevated at over 18%. And we saw the best performer for this week. There was really only one that finished in the green. It was materials, XLB, at 45 basis points. The worst performer was the discretionary, down about 2.18%. Okay. But really, if you take a step back, in these markets, we're kind of in an ideal market for equities. We've got lower, slow growth, lower interest rates, and lower inflation. So we've got all of these things working to drive these forward PE ratios up over 18.04, as I said. And the dividend yield of the S&P is at 1.9%. The 10-year interest rates are hovering around 2.05. So it really is driving money into the equity markets. And even with the current 10-year at 2.05, there's still higher probabilities of 3 more rate cuts this year, which I think is overly optimistic, but we'll talk about that in a second. Either way, this still encourages, folks, more money flow into the equity market, looking for higher yields. It also supports more corporate leveraged business loans, right? More corporate bond issuance. And a lot of the corporations are not using it to invest in plant and equipment and stuff like that. They're using it to increase their dividends and or buy back stocks, buy back their own shares, to drive up earnings per share. In fact, we're seeing stock buybacks, as one of the major contributions to rising markets. So this will all come to an end, but near term, I think it's still very supportive of a higher price action. But like I said, longer term, it does set the markets up for pretty good large drawdown into a bear market. So our superstars in the market, as I said, is the U.S. consumer. I mean, we've seen weakness in manufacturing, weakness in industrial companies in the first half of 2019, yet the U.S. consumer has been very, very strong. I mean, we just got this past week June retail sales, and the annualized growth was over 6.1%. That's the fastest pace in over 15 years. And to cap off this strength in the consumer, which, by the way, is about 70% of the U.S. GDP, those companies that have already released their Q2 earnings, those that are consumer focused, B2C, business consumer type businesses, are leading those that are more sensitive to manufacturing. So clearly the consumer is just kind of pulling this market forward here. And with lower rates expected to come, I think it's only going to give the consumers another assist, right? So I think that is it's just going to me, support higher price action in the near term. All right. And by the way, we also got a consumer sentiment gauge this past week, which is still very optimistic. So coming up in the next 2 weeks, as we round out July, the markets are still kind of guessing how much the Feds are going to cut. The probability this past week was over 70% for a very brief period of time, of a probability of 50 basis point rate cut, which to me is totally astounding. And now it's back down around 19, 20% for 2 rate cuts, and almost assured 100% probability of a rate cut of 25 basis points. It's 1/4%, according to the 30-day Fed Fund futures market. And guys, for me, I don't like putting a probability of 100% on anything that is future based, well, except maybe death and taxes and okay, maybe a dovish Fed, but outside of that, 100% probabilities for the future for me, just, I don't like them. And, just how dovish the Feds will be, we're soon going to see, but I will remind you guys, if market expectations are not met, we're going to see a severe downdraft in the markets. Right now, the Feds, we're going to get it. I don't think they're going to come out and just say, well, if they cut, let's say, by 25 basis points, I don't think they're going to say we're going to cut another two this year, which is what the markets are forecasting, 3 rate cuts for the year. They'll come out and Power Ranger Boom Boom Powell, pretty much our illustrious Fed chair, which I like, by the way. I like him. But he did come out and say we stand supportive to keep this economic expansion. We're supportive of this economic expansion. So now they're in the market business. Now they're in the stock option business, which they really shouldn't be. But with inflation very low, nowhere to be seen, I mean, why not drive the rates down a little bit lower in anticipation of a possible slowdown in global growth, which could possibly slow down the U.S. economy. Now, all of this is possible. And we'll see how this leads out. One thing that I was watching and I read this weekend over in Barron's is if we look at the 6 leading banks across Europe. Now, these are the 6 leading banks all across Europe. Their combined market cap is around 200 billion. And if you look at Bank of America's market cap is greater than 200 billion. So you got the 6 leading banks across Europe, still less than just one of our big money center banks. That kind of shows me, and it should kind of show you and highlight to you the limited scope of banking across Europe and just how sophisticated the U.S. market really is, which is why the U.S. market kind of leads the global economy all over. Not to say that a misstep in China, followed by more missteps across the Asia-Pacific area from South Korea to Japan, and others, and then the resulting misstep in Europe couldn't wash across our shores and drag us down kicking and screaming. That can happen, but I think near term it won't. Okay. And speaking of banks, so I was looking at this article in Barron's, and they're basically, according to them, the average PE ratio in 2019 for banks is around 10, which are record lows, and the dividend yields of banks is around 3%. So Barron's feels that banks, on a go-forward basis, U.S. banks represent a really good value over the next few years, as we go into this aging bull market. And I would support that thesis, okay? One other thing that I like, and I've been talking to our members about now for quite some time, I'll show you in the charts here in a minute, is gold continues to shine, okay? I've been hot on this commodity since we broke out of this longer-term ascending triangle base that I showed you guys on the charts. We'll take a look at it again. The minute we broke 1372, that was a go long event, in the gold side. And I've been long silver via SLV for a year or so when it was down much lower. I do like these, to the upside, especially as we get into an aging bull market. Okay. I just saw a little note that there's an estimated 6 billion ounces of gold in the world worth about $8 trillion. And they mint newly each year, maybe 2% of that total supply. So I don't think there's going to be an overabundance of gold. And I think as this bull market continues to age, I think you're going to see the allocations of big money funds and hedge funds, pension funds and so forth, allocate a little bit more to gold in their portfolio. You know, they may have 2 or 3%. They may up that allocation to 5%, to even up to 8 or 9, maybe even 10% more aggressive funds. So all that means is more buying for gold. Now, keep in mind, gold is subject to inflationary fears, just fears in the global markets, fear of slowdown, and interest rates. All of these factor into where gold goes. But I think near term, I like gold to the upside. Okay. Now, looking at the charts here, you can see I've got on the screen here the S&P 500 E-mini futures. All right. And you can see we hit my first target here, both time and price, and we're pulling back. I've said we can expect a pullback probably into the low 2900. I told you guys that. It's an Elliott Wave 345 pattern. It's very simple. There's some lower degree Elliott waves within the Elliott waves. And I really don't get too much into the Elliott wave count because it's always changing on you, but it just gives you a general perspective. But you can see there's an upward vector on both this red line and the yellow line, the red line being the 50 EMA, the yellow line being the 200 EMA. You can see this long extended yellow line right here sitting at 28.85. That is where the most volume has taken place in the S&P E-mini futures, going back 90 days. All right, actually it's 90 bars, but in this case it's a daily chart, so it's 90 days. So that tells me that's a big value area, big support area, and you can see this estimated pullback using Fibonacci. You can see kind of where I would see. So I had said all along, probably a pullback of 2.5 to 4% is what I was expecting to see here. I'd be surprised if we don't get it. You can see I don't see any divergences in the MACD, so that does suggest that any pullback is probably going to be bought. And if we look at the RSI, you can see we're still over the 50 RSI band or in the range. So that still tells me that I'm looking for this 50 to hold. If we do move below it, which we did back in May, then I don't think it's going to stay down there too long. But this is kind of where we're sitting right now in the E-minis. If we look at the global markets, it's a completely different picture. Okay, let me just put this on a weekly chart here on the E-minis. You can see here we hit my target here back in September when we made our September highs, you know, right around these 29.50 area, 29.60 areas when we hit our September highs. And then we finally broke out and made new 2019 highs and then new 2019 all-time highs right here. We hit my target again. This target up here is for a longer term. My target up there is right around the 3100 area, which I think we will be able to get to. I don't think it'll take too much effort to get up here, maybe even higher than this over the near term. I think when I say near term, I'm really talking anywhere from 3 to 6 months out. I say short term is anywhere from a couple of weeks out to maybe about a month or so. I think the markets are rather mixed, maybe a little bit of a pullback, but you could see kind of where we're sitting here. But you can see that we've made new all-time highs. Now, if I keep it on a weekly chart, and let me just take everything off the screen here. Well, let's put it back on. I'm gonna switch over to the Russell. And if we look at the Russell futures, this chart is entirely different. Let's take everything off. You can see on the Russell futures, we we haven't gone anywhere. I mean, that was the highs made back in September, you know, and in here the lows, and this is where we're sitting right here, almost right on that value area right there. That is where the most volume has taken place in the Russell, going back 90 weeks. All right, and it goes all the way back to Q4 of 2017. So, and you can just see the volume bars right here like this. So this is a no trade environment for me for the Russell. We've got this big question mark. Where does it want to go? Does it want to go up and support a longer run in the bull, or is it going to roll over and pull the other markets down? This is a to be seen scenario. And you can also see, I don't have it on here, but we're sitting right on the 50 line on the RSI on the weekly. So it's going to be real interesting to see where this thing flows. Now, the other thing I will say, and let me just put the indicators back on the screen again for you. You can see here that if we come over and we look at the transports, okay? So here's the Russell chart on a weekly. So now look at the transports on a weekly. Notice here the transports over the weekly, we haven't made all-time highs here either, okay? It looks very similar to the Russell. We made 2019 highs. Obviously, you got to have a high in 2019, but that's nothing. We have not made new all-time highs. And we're kind of sitting again just slightly above the 60 percentile level off the lows of the range from September's high to the December lows in Q4 of this year. So we haven't gotten the oomph that we needed in the transports that I would like to see to support a run higher. Okay. So we're in this question mode here, which is why I believe we're going to pull back just a little bit, allowing more buyers to come into the markets. That's what it seems to show to me. And then one other one, look at the world markets. Now, the world markets, this is the Vanguard All World Index. This is even worse. The last all-time high was made when we made highs in January of 2018, and we're well off of those. I mean, we're just dramatically lower. So the rest of the planet outside of the US really is just a pig in a pen, right? And the US may be a dressed up clean pig. Arnold the pig on Green Acres. Arnold could talk, I think. Maybe not. Maybe that was the horse. Maybe that was Mr. Ed. But Arnold had lipstick. So that's kind of where we are right now with the U.S. markets. And I think lower interest rates can goose the markets even higher. It's going to make for the back end of that really ugly when we finally push over. But that probably can extend the market upward momentum at least another year or so. And that's kind of what I think most of the politicians would like to see. Clearly move it higher. And that's kind of what we're seeing here also. So you can see this all world index. Now, if we look at China, China is the same. The tracking stock for China is Asher, ASHR. The exact same right here. I don't know why it gives me this signal, but let's come back to a weekly. I have to flip it around sometimes to get rid of the signal. But Asher is almost the same as the All World Index, right? Look at this. I mean, we had a high here in January 2018, and then we haven't even come close to that. We're at right at this value area here, okay? Just slightly below the value area. Now, if we look at, let's compare and contrast this to the E-mini futures, right, of the S&P. We look at the E-mini futures, same time frame, same everything, right? And if we look at January, where the markets made all-time highs, that was right back here. That was the last time we've seen all-time highs in emerging markets, the Chinese markets, and it's just we haven't seen it. And yet the E-minis have moved up to new highs here in September, and then right back up here again just recently over the past week, right? So, but also look, as we've been making higher highs, the RSI has been steadily going flatter longer term. So that just tells me that we're setting up for a little bit of a calibration here. Now, it may be a little bit bigger than I am projecting, but I'm saying anywhere from 2.5% to 4%. Okay. So if we look at the price action and we just kind of do some kind of manipulation here on that, and we say, well, the current price is 29.71, right? So 29.71. And we come in here and we say, okay, if we look at 29.71 times 0.04, that's about 118 points, okay? And if we take the 29.71 minus 118 points roughly, that puts us down right around this 28.50 area right here, which is right where my forecast is on this weekly chart. That would be about a 4% pullback, right? Now, I had said 2.5% to 4%. So that puts us right around the lower 2900s. And if we blow through it, maybe down to 2850. And we will still be in a very strong up mode for the markets, even with that kind of pullback, all right? And that'll put more pressure on the Feds to hike the rates even more. But if I were to let me just clean up the screen just a little bit here, like this. And let's just stretch it out. So if I were to you know, just quickly hand draw on here, a well, let's hand draw it like that. You get the idea. So that puts us right in that area there, this trend line. I was off just a little bit, but it'll put us right at that level there, right at 2850, 2852. So that takes us back down here like that, and we won't be a straight line down. It'll probably kind of move down in this area here and then bounce around before we, start climbing higher. If the Feds come out and say, hey, there's another rate cut coming and so forth and so forth, that'll get us up to my target here around 3100 before we give it all up. Or 3100 to 3150. We can still move up higher though, guys. So don't let your logic get in the way of price action and momentum. All right. We're in one of these kind of last hurrahs. It can last a year or so in the markets before we finally give it up. Remember, Alan Greenspan, the illustrious Fed chair in the late 90s, coined the term irrational exuberance. And he did that, I think, and then it took another 2 years before the markets finally gave it up in the year 2000, okay, when we had the dot-com bubble. So we still got momentum, can still carry us, okay, a lot higher. So that's a little bit about what I'm looking at across the U.S. indexes. And of course, if we look at the Dow and NASDAQ, they're all the same, right? So if we look at the Dow, you can see here we made all-time highs here this past week, and then we just fell off just a little bit on Friday. And same thing with NASDAQ. If we look at NASDAQ, put NASDAQ 100 futures up here, you can see we made an all-time high here, all-time high. And we just missed my target in NASDAQ futures, just barely, right? My target was a little over 8,000, and we had 8,001. My target was about 8,068, roughly 8,068, okay? So, we're coming close to my targets. I do see a little bit of a slight drift here. If we look at the FANG index, right? Even the FANG index, which is kind of a combination of Microsoft, Apple, Facebook, Netflix, Google, Amazon, even though Netflix crashed, they didn't hit the subscriber growth, and there's speculation they could pull back. So the FANGs have led the U.S. markets for the past couple of years. I think we'll see a shift to more cloud-based and 5G type software solutions, consumer-driven solutions, as I said earlier. Those tend to be leading the way. So that'll kind of give the market some lift. Excuse me. So this is what we're looking at. If we look at the VIX, we moved up, but we're still in the green. This green zone here gives us certain proclivities, a certain kind of option trades where we want to be long gamma, long vega types trades. And we put on another gator trade that was successful for us this week. Those things tend to be very consistent in making money. Oh boy, I got this cough. So we can see where we are here. And if we look at the front month vol skew, you can see here we're still in a contango right here in the green. So the front month vol skew looks very good. The back month vol skew is even better. Look at how deep we are in this contango. That's going to be very supportive. Excuse me. This is going to be very supportive, guys, of further big money going in and shorting volatility, which is going to make volatility pops even more severe, okay? Big money's out there in droves shorting vol. And you saw what happened when we got too many shorts in the market in January 2018, because the only way to cover a short is to buy it back. So it tends to make volatility, when it does pop pretty good. But we're in a normalized contango term structure, both front and back month skews in the vol market. So I like that. Again, this is supportive of market action moving higher, okay? And if we look at U.S. Treasuries, well, we pull right back to the 50 EMA. I had projected right here. Let me see if I can get a little bit of a tighter projection on this thing and just put it right here. This is generated off a combination of Gann and Fibonacci extensions. tends to show a move. Bonds can move up to 158.08. Now, if the Feds do come in and they cut like they're talking about cutting, where we have 3 more rate cuts, we will see bonds north of 158, 159, which means interest rates are going to be lower. You can see there's a lot of momentum in the bond market right now. You can see bonds, you know, coming back here have just been steadily moving up since Q4 of 2018. That's a long time, guys. I mean, we've just been moving up the entire time. All right. We move up, we consolidate. We move up, we consolidate. We move up, we consolidate. Now we're in another consolidation mode right here with the bond market. You can see the value area for bonds is sitting right at a 153 handle and 30 ticks. All right. And we're sitting at 154 handle, 24 ticks. So we're close to this value area supported by the 50 EMA. I don't see it going lower near term, all right? Not with Fed rate hikes coming in, unless they come out and they are more hawkish in that they cut the rates 25 basis points, and the words that Boom Boom Powell uses are more hawkish. Now, they ran some stats. Every time Boom Boom Powell, that's our illustrious Fed chair, Power Ranger Boom Boom Powell is what we call him. Every time he talks, not every time, 75% of the time he talks, markets go down. All right, so let's see if he can talk the market back down again. But if he comes out and he's more hawkish, and the probabilities of 2 more rate cuts, if they cut this time, that would be the first one, but even 2 more come in more, we could see a situation where they cut the rates and yet the market sell off because he's not dovish enough, because they've already priced in 3 rate cuts for the year. Really crazy. So we're going to watch this very closely. Of course, if we look at the 10-year interest rates here, we closed the week right around 2.048. Let me just get it back out here like this. A little bit longer term, you can see just how the rates we were at in October of 2018. The rates were at 3.24 for the 10-year. Amazing, right? I mean, just less than a year ago, the rates have fallen from 3.2 all the way down to 1.9. I mean, that is just crazy. Look at this, right? All the way from 3.2 down to 1.9. That was the low here, and now we're just barely up off the lows. We haven't seen these lows here in quite some time, going all the way back to 2016. Okay. Now, this is a lot. It takes a lot of momentum, a lot of buying in the bond markets for fear that the aging bull market is going to end. Money is poured into the bond market, which has driven interest rates down like this. So now the question is, where does it go to from here? Okay. I think the bond market, and I've seen forecasts where interest rates are going to go back down to 1.5 in the 10-year, and I've seen other analysts forecast rates are going to come back up to this area right up here around 2.3 to 2.5. Where do I think it's going to go? It's too hard to tell right now. I think it's a 50-50 coin toss, whether it goes lower or goes higher. So it's not a bet I'm willing to make. Short term, we can play them clearly. But I think what the charts seem to indicate is it's going to go lower. Okay, charts seem to indicate we're going to bounce up a little bit and then roll back over and continue this downward trek in interest rates, which then is supportive of this bond market right here with bond prices, and this is a weekly chart, but supportive of bond prices moving higher. If I take it back to the daily, you can see here in the bonds, you can see where this red line, which is the 50 EMA, has been supportive of bonds, and you can see the target that I have here is around 2158. All right, so that means higher prices for bonds, lower interest rates. If we look at the US dollar, what are all these lower interest rates doing for the dollar? Well, the dollar is still bullish. If we step it out, right, you can see this very wide regression channel. The regression channel factor here is 0.56. The lower the factor, the wider the channel. But either way, it's clear the direction of the channel. I mean, when we get at the top, we sell off. When we get at the bottom, you want to be a buyer of the dollar, right? But you can see here clearly, even with lower interest rates, money is still coming into the U.S. markets. Why? Because the U.S. market is the only pig with lipstick in the pen right now, right? So it's Arnold the pig. So the U.S. economy's been doing great. Now it's been jacked up on steroids with low interest rates and a ton of cheap money floating around out there. But the end result is a very strong economy, less regulation, very low unemployment, low interest rates, low inflation. Um, and that's what it's done, and it's moved the markets higher. So money's come here, and it comes here in the form of US dollars. That's supporting the US dollar. Even given our very low interest rates, they're still better than everybody else. So even in a global market, you've got that there is no alternative kind of environment. And look at the euro. It is just the opposite. If we look at the regression channel in the euro, clearly it's easy to see the direction that sucker's going in. Lower highs and lower lows. Every time we get to the top of this regression channel here, you can see that it sells off, and it doesn't venture out of this regression channel very often. That yellow line is the 200 EMA, right? And we only spend just a couple of days north of it, going all the way back to Q4 of 2018, right? So a little less than a year. We don't spend much time outside this regression channel. In fact, we exceed the regression channel more than likely to the downside than to the upside. And this is kind of where we're sitting right now. As I said, those banks in Europe really suck right now. Most of the negative yielding government debt is in Europe. Okay. And one of the worst defenders right now is Germany with the German Bund. I mean, it's just very, very low. So that forces money into the US market. So that's why being long the euro is really, to me, just a short-term counter trend trade. Right? Longer term, it seems to me it wants to go lower. Okay? Short term, it can go anywhere it wants to go. Okay. And now the yen, which is a global risk off trade, you can see the yen came right back up and made the highs that we had in January here. Because remember, in Q4, especially December, this December was the worst December the US markets have seen this past December since 1931. Very bad. And look at what the yen did. All the money rushed into the yen right here very quickly. And then it proceeded to sell off. And then starting in end of April, early May, when the market sold off, the yen slowly um, moved all the way back up here, very close to where it hit in December. And now we're struggling with these highs here. So the yen is like poised to go higher should global growth story continue to slow. If we can see Europe starts to catch wind and grow, and the German Bund move out of negative yielding territory, that giant sucking sound you will hear at that point in time will be the U.S. interest rates rocketing higher, bonds rocketing lower, and that'll probably put a ding in our U.S. equity market, and you'll see money flow out of the U.S. back into Europe. But I don't see that happening anytime soon. In fact, this week, we got the ECB meeting on Thursday, and the odds favor them to cut the rates a little bit more negative, right? So we're going to get that picture this Thursday. And by the way, this Friday, we're going to get the first pass of US GDP. So it's going to be an interesting week. There's a lot of things to take a look at. Now, if we look at oil, if you guys will recall, I've been saying it over and over again. I think you guys understand. And I've been sticking to my story. I've been saying oil's value area in my mind is around the mid 50s. Okay. With global growth as slow as it is, oil is going to have that huge lid over it. The only thing that have kept oil elevated right now is the issues in the Persian Gulf. All right. And we just saw recently where Iran just took two UK licensed or flagged oil tankers. So I think they let one go and they're still holding one, but that just is enough. And before we had fracking in the U.S., oil would have been up, another $4 or $5 a barrel. But because now we pretty much self-stabilize our own oil needs, pretty much, oil is down, right? I mean, it's just crazy. With all of that, if I were to tell you that, you'd say, well, oil should be up, but it's actually down over $3 or $4 a barrel since July the 12th, even with all that nonsense going on in the Persian Gulf. And we're come right back down to my area here. So now once we're in this area here, we're kind of 50-50 where it's going to go. Momentum may carry it lower, but I don't think it's going to go much lower. We're going to be chopping around in this area here. Okay. Now, the one thing I do like, and I've pointed it out to our members, is nat gas. Nat gas, you can see here, we broke this trend line right here. And I think I pointed this out to you guys last week. If not, maybe it was just to the members. I said that would be to me, a short to take us back down to this level right back down here, okay? But once we get down here, I'd like to take out these lows right here. If we can take out these lows, then what I'm going to do is right in this area here, once we stabilize, I'm going to be selling puts out of the money like crazy because I think it's going to be supportive of nat gas moving back up again because we're very, very low as far as price in nat gas. And China's needs, we're going to be, as we build out our LNG ports in the Gulf of Mexico, China is, they've of their energy burn, I think 6 or 7% is nat gas, and that's projected to grow to 15% over the next decade or so. So, and we've got the cheapest nat gas in the world. So Trump is working like crazy, and rightfully so, to become a major exporter of nat gas, not only to the Asian markets, but to the European markets as well. That'll only help be supportive of nat gas, in the future. But again, short term, I think we're going to, the odds favor a lower move in nat gas. If we can take this out, then I'll be more happy to look at selling puts underneath the market in nat gas. Okay, so that's a little bit about where they go there. Now, as I said, in gold, this was that ascending rising triangle that I talked about here, and I pointed it out to you guys as well. So you can see here, when we broke out of that level right there, right around the 1372 area, 1373, that was a buy for me. In gold, there is no divergences there. I said any move back is going to be bought. You can see my initial target was sitting right at 1409. We're at 1426, so we've blown through it. It just shows the strength of the gold market at this point in time. If we put it back on a daily chart, you'll see gold is bouncing around here, but we've made new highs here. So and this initial target area is now going to probably serve as a support area for the gold as it starts to build a longer term base to move higher there. Again, there is no divergences here. And should there pop up a divergence, I would probably add to gold if it pulls back a little bit to this breakout point right here. Same thing with silver, guys. I mean, I like silver to the upside. Look at what silver did, okay? Now, I've been pointing to silver. It had this huge, huge move up. It was a catch-up move because, as I said, silver has been playing catch-up to gold for quite some time. You can see this downward angle here. And the minute we broke the triangle here and started moving up, I mean, that's a little bit, I think, a little bit stretched. It'll probably pull back a little bit, but any pullback in silver should be bought. Now, the best way to play it if you don't have a larger portfolio is just play SLV, right? And if you look at SLV here, we broke this line right here, which goes back quite some way, okay? You can see the break here. In fact, I put this back to right at the end of Q1 of 2017. We had one little break here, but this is a severe break. So I could see a little bit of a pullback, a test, and then a move higher in silver. Remember, big money has not been playing and active in the gold and silver markets for some time. But now that we're getting into an aging bull market, this just makes sense to me, okay? If we look at palladium, I wanted palladium to go higher. And it's rolling over a little bit. Maybe if we can get a little bit of a move higher, one final attempt. This was my shorting opportunity. Let me just get this off the screen here. This was our last short in palladium right here. We took the short on the divergence, and we had members making over $30,000 per contract in less than 3 days. It was a great trade. So now we've made a new high. We're getting the requisite pullback. I'd like to see one final last gasp attempt. We may not get it, but if we can just get some stabilization, then if it does move lower, that would be an interesting short there. There's also some interesting plays in soybeans, corn, and wheat tied into China, more soybeans than anything else. Same thing with lean hogs, and then in meats. coffee, and some of the softs. We're getting some opportunities in coffee maybe as well. Members, I'll review this with you this Sunday evening. If you're not a member of our group, I highly encourage you to come in and join us. We're having a great time this year, especially in the commodity markets where they've been killer for us. And I think we're going to continue on through the end of this year. There's going to be some surprises coming up, not only in commodities, but in some equities as well until we finally roll over. All right, everybody, have a really great weekend. Stay cool if you can. Members, I'll see you this Sunday evening. Take care, folks. Ciao now.